Thank you, Mr. Chairman, and welcome, Chair Yellen. It's good to see you here. So, back at your confirmation hearing, you said you thought the Fed's supervisory and regulatory responsibilities were as important as the monetary policy responsibilities, and I agree. But I think current Fed practices don't reflect those values. So, while the Fed's Board of Governors votes on every important monetary policy decision, the board rarely votes on issues like whether to settle enforcement actions. Last year, the Fed reached its largest settlement in its history, $9.3 billion, with mortgage servicers affecting more than 4 million families. But it was the Fed's staff that worked out that arrangement, and the Fed board didn't even vote on it. So 2 weeks ago, Congressman Cummings and I sent a letter to you recommending that the Fed change its rules so that the board would have to vote before any major settlement. Do you support such a change?
Senator, I think that you have raised very important questions about this, and I do think it's appropriate for us to make changes, and I fully expect that we will.
So, and in principle, support what we've asked for in this letter, that is clear and concrete evidence that the board is involved in supervisory and regulatory policy.
It is completely appropriate for the board to be fully involved in important decisions, and
voting is a good way to do that.
I fully intend to make sure that we are.
Thank you. Thank you. Now, I want to ask about another aspect of the mortgage settlement. When the deal was struck, the Fed had a big press release to announce a $9.3 billion settlement. But it turned out that of that $9.3 billion, $5.7 billion was in the form of credits for what the Fed described in its press release as, quote, assistance to borrowers such as loan modifications and forgiveness of deficiency judgments. What the press release didn't say is how the credits would be calculated, and later it came to light that under the agreement, mortgage companies could get away with actually paying only a fraction of that $5.7 billion. Now, the fine print in this settlement could potentially reduce the direct relief to borrowers by literally billions of dollars. So Senator Coburn and I recently introduced a bill, Truth in Settlements Act, which would require every agency to publicly disclose the key details of their settlement agreements, including the method of calculating those agreements, whether it's tax deductible, and so on. And the disclosure would be required up front at the time the settlement is announced. Now, the Fed doesn't have to wait for Congress to do that. You could voluntarily adopt that public disclosure now. Will you do that?
So I agree with you. It's important for us to disclose more and to disclose as much as we can. And we'll look at that very carefully and try to provide more information.
So in principle, we're talking about more disclosure here?
Correct.
You know, I think this is really important because this is about accountability. We want to be able to hold our financial institutions accountable, but it also means accountability for our regulatory institutions.
Agree. It's a principle I endorse.
Good. Thank you. And I want to just follow up quickly, if I can, on Senator Brown's question about too big to fail. You said that we've made significant progress, but much work remains to be done. And I agree. But I would note that since the financial crisis in 2008, the 5 largest financial institutions are 38% larger than they were back then. So my question is, what evidence would you need to see before you could declare with confidence that too big to fail has ended?
So I'm not positive that we can declare with confidence that too big to fail has ended until it's tested in some way. I mean, I do believe that there are demonstrable improvements in terms of the amount of capital and liquidity that we have, put in place both through stress testing and Dodd-Frank regulations. There is more to come, in the form of SIFI surcharges and likely a supplemental leverage ratio. There is a whole agenda here of minimum debt requirements. I think it's important to feel that we have solved too big to fail, that we have the confidence that if an institution were to get in trouble, that we could actually resolve that institution.
And I'm over time, so I really will quit, Mr. Chairman. He's strict with this, but I just want to draw in on this a little bit. So long as the markets believe that too big to fail has not ended, and they demonstrate that by reducing capital costs for the banks that are perceived to be those that the government would rescue, do we still have a too big to fail problem?
Well, the markets may think that we will rescue such an institution and may not end up believing us until we put it through resolution. So we can't guarantee that they have an appropriate view of how we are going to handle such a situation. But I do think it is appropriate to look at estimates of subsidies and so forth in judging what progress we're making. I don't think it's definitive, but it's certainly appropriate to keep track of those market metrics. And I mean, we see that rating agencies are changing their methodology, diminishing the amount of their estimates of the amount of support that would be forthcoming. And I think as we complete our work on orderly liquidation, putting in place minimum debt requirements, and working with foreign supervisors to feel we really could affect an orderly liquidation if it came to it, that estimate of market subsidies should certainly come down.
Well, thank you very much, and I'll look forward to our continuing to track those data.
Very good.
Thank you, Mr. Chairman.